Welcome in. You are listening to another episode of the Keep the Change podcast. We've got Adam from Compound Wealth back in the studio. Mate, it is good to see the birthday boy. I am keen to rip into some KiwiSaver facts, frequently asked questions.
Let's do it, mate. Let's rip in.
This one is actually KiwiSaver myths, we've called it, but I just wanted to swear because I feel like I haven't for a bit. So apologies to anyone out there listening that doesn't like swearing, but I'm going to go through, I'm going to ask you a number of questions about KiwiSaver, but these aren't going to be like, how do I get it out for my first home? The boring stuff that people can probably find if they Google it. They're going to be a little bit more grunty and for experts maybe. Intermediate level content, this, mate.
Yeah, let's call it expert.
Okay, expert. Yeah. Righto. Well, you're an expert if you're listening to this team. Number one, is now a bad time to switch KiwiSaver providers? And this is June 2023. So for some context, the market's a bit shaky. The market's been coming backwards. People saw highs in their KiwiSavers and then they've started to see some lows. But there seems to be a bit of I don't know if I should change KiwiSaver providers.
Great question. So I think probably that initial COVID blip that we had, right, where markets kind of just went boom, 20, 30% drops, everyone started freaking out. A lot of people, there's a lot of media articles going, don't switch your KiwiSaver fund from, say, growth to conservative or, a balance down to conservative just because the value of your investments fall. And what that's done is it's kind of created a little bit of flow over into, if you switch KiwiSaver providers, that's the same thing. So that's definitely a myth that now is a bad time to switch KiwiSaver provider. There's never not a good time to switch KiwiSaver provider. It's pretty easy to do. Effectively, your funds are transferred to another KiwiSaver provider in 10 working days or less. But the only time you probably wouldn't switch provider, right, is if you're going, say, from, it depends what the reason is. If you're switching because of markets, but you're going from, KiwiSaver provider A from growth into KiwiSaver provider B conservative, and you've still got a long investment time frame, then yes, that's a bad decision. But if you're choosing a KiwiSaver provider and you're moving from a similar asset allocation level, then if that KiwiSaver provider aligns with, your values and has kind of certain features and an investment philosophy that's, that you like, and that's got a proven track record, then yeah, do it. There's no reason why you shouldn't switch KiwiSaver provider just based on market conditions.
Okay, so there's the two distinct differences there. One's changing providers
and changing, say, funds.
Yeah. So I'm with one provider and I'm in growth, and then I decide I might go to another one but go into conservative. But really, I've still got a 30-year time frame to using my cash. You'd be asking me, why am I doing that?
100%.
Okay, that makes sense. So I think a distinct difference for people to understand there. Is that what people are asking you quite a lot?
Well, it's more like, I dealt with someone last week and I just said, hey, look, well, you should be an aggressive fund based on your risk profile and, your capacity is, say, 25 years. And he's in a growth fund at the moment with, say, KiwiSaver provider A. I said, well, this is a more aggressive solution. So you're actually going up from, say, an asset allocation of 80% growth assets to, say, 95% growth assets. So you're going up the risk curve, but you've got 25 years. And he's like, well, now's not really a good time to switch because of the market. So I said, well, now's a perfect time to switch because you're moving up the growth allocation curve. Yes, over the next 12, 18, 2 years, 3 years, the markets might go down. But, what we talked about in that previous potty was the dollar cost averaging thing. So even if that does happen, eventually we know that shares over the long term are going to outperform. So yes, switch from KiwiSaver provider A into KiwiSaver provider B that has that aggressive asset allocation, move up the risk curve. Don't try and wait for the markets to come back because you just don't know what's going to happen in the short term.
Something that people often ask me is, and I don't really provide any insight or where to go from here, but they say, should I set my kids up with KiwiSaver? So from someone that's actually in the space, what is the answer that you give people?
I say it's not a must do. Like it's not something that, you have to do, because you have investment managed funds, say, outside of KiwiSaver that probably give you more flexibility. And then, in 20 years' time, you don't know what the government's going to do with regulation. So, they might say, first home buyers can't take it out of their KiwiSaver anymore. So it's one of those things. It's like, it's great because once it's set up, and if you put in $10 a month or whatever it is, $5 a month, and do that for 20 years, obviously you're going to build them up a really good start to their nest egg or their first home balance. But it is quite restrictive in that they can only use it for their first home or for retirement. So if you don't mind setting your KiwiSaver up for your child, and having it so it's for their first home, then great, do it. But if it's like, well, I'll set one up, you can easily just set up a managed fund, very similar structure to a KiwiSaver, but just doesn't have the same, obviously rules around it.
Yeah.
But they could use that for university or whatever. So there's no right answer to it. It just depends on, I guess, someone's preferences. But I think when I have kids, the first thing I'll do is sign up old Johnny or Sally and chuck them in KiwiSaver and set up $5, put $10 a week in there and put them in aggressive KiwiSaver strategy, because they're not going to be able to touch it till they're probably 40, because that's when they'll probably be able to buy a house. And then, well, not if I help them with the $5 a week. That'll compound.
Yeah, compound
but
wealth.
That's the first thing I'll do when I have kids, is I'll set them up with a KiwiSaver and probably some sort of managed fund. The managed fund would be probably the university fund or something like that. And the KiwiSaver might be for the first time in their late 20s.
I thought you'd call your son Warren.
Or, call him Warren or Charlie.
Yeah, good.
One-eyed Charlie.
They might not need the uni fund, because they might just take the pot and just start investing.
Well, yeah.
Yeah. Okay, and the kids can't get the $521?
No, so that's another thing. So you can't get that until you're 18.
Till you're 18?
Yeah.
Okay, sweet.
Yeah, so that's 18 to 65 that you get the free money. So you don't have that government contribution benefit.
Now, I think, as always with this content, things can change. So depending on when you're listening to this, keep an eye out for what may change in the regulation. And that's exactly what you're talking about. The regulation could change, where eventually they say, Luke gets into Parliament, Prime Minister, and he removes it. He says, no, KiwiSaver is designed to help people for their retirement, so you're not buying a fucking house.
Yeah.
So you got to be careful, because people like me may end up in there. Or they'll get enough bloody votes on a petition. Has any petition ever that's been signed ever actually led to anything? That's probably not a good question.
Yeah, I can't.
Not a good KiwiSaver question.
Anyway.
So then the next one is, I'll see people, they'll use their money for for a property, and then they get into that, should I keep contributing or should I not contribute, and should I pay down my mortgage?
Great one. So this is a really good one. Obviously, with interest rates at 2 or 3% not long ago, then your KiwiSaver growth or aggressive strategy is probably you don't mind investing your 4 or 6, the extra money from the minimum into your KiwiSaver. In today's current environment, where you're 7% for a 1 year fixed rate, I think it is, and then 8% for a variable rate, you're probably just going to pay down your debt, and your mortgage, because you're conservative or you're balanced, or you're, even your growth KiwiSaver strategy. Is it going to return? Well, you're conservative in your balanced funds, you definitely aren't going to return more than 8%. Over, say, a 10, 15-year time frame. They could, but highly likely that they wouldn't. So my advice would probably be, probably pay down your debt, because it's quite expensive at the moment.
It's guaranteed.
And you're guaranteeing that, that price lock-in.
Yeah.
So, but if you're invested in, say, an aggressive KiwiSaver solution where, you might earn a little bit, you might earn more than 7 or 8% per annum, then you could say that, well, I'd rather invest that money in KiwiSaver. But I haven't really heard of anyone that's paid off any debt going, I wish I hadn't paid off that debt.
Yeah.
You know what I mean?
I think, you're the financial advisor, not me, mate. But the other thing is that what I noticed, because I stopped contributing so that I could pay down my credit card. So effectively the same thing. but then I paid it off, and it becomes very hard to decide to turn it back on because you get used to that money you're getting.
The disposable, yeah.
Yeah. So something to be mindful of is like, when do you then flip back to, okay, I'm going to invest for the future, but also you've got to then look to pay down your debt, try and pay it off faster, and then start putting all that money that you would be paying on your mortgage, like putting it into investments anyway to play catch up. But also you're going to miss the employer contribution if you're not kicking any coin in.
Yep.
And then maybe you want to think about doing the minimum just to get the 50% guaranteed too.
That's that's a no-brainer.
Yeah.
Like the 1,042.86, get the 521.43. That's definitely a no-brainer.
All right. In general, because I know you read up a lot about the different funds across the board, how have they been performing, and any trends or any things you noticed in there that might surprise people?
So latest kind of Morningstar survey was released end of March this year. So the next one will probably come out soon. I think the average aggressive strategy over the last 10 years, 8.6, growth 8.3, balanced, I think it was about 6.5, and conservative, I can't remember off the top of my head, maybe around that 4 mark. So that just gives you kind of an indicative nature of average returns across, say, your multi-sector funds from conservative up to aggressive. The last 6 months, we talked about this in the previous pod, things have lifted up quite well. So, considering all the news about recession and that in the market, people have actually been, things have bounced back from last year. It's very rare that you see in, history over, 50, 100 years that you have a red year in the market like we did in 2022, that, the following year's another red year. It's more likely that, if it's down quite significantly, the following maybe year or two is actually a really strong year.
Yeah, I think as well, like one thing that I've been trying to get myself mentally to accept is that what was happening in 2020, 2021 wasn't normal, right? It was just out the gate. And I think that's when a lot of people started really looking at their KiwiSaver more, getting into Sharesies, etc.
More time.
Yeah, and really we probably need to prepare ourselves mentally for, and not to expect the high levels of growth that we saw.
100%.
Yeah.
It could be 3 or 4 years we just stumble along. But that's not a bad thing for the long-term investor, because it's all about patience. Like if you can just stick to it, one day it'll come and you'll reap the rewards.
But how do we practice being patient in a world where everything's just fucking bright pastels, like just enjoy your life right now? And
good question, Lukey. I wish I knew.
Yeah, the buy now, pay laters, etc. Everything is marketed to us the other way. Like, can't afford it? No worries. We'll split it out into 4, 5, 6 or whatever. But that's the same as me. I was not contributing to my future. I am my KiwiSaver, and I was paying down my credit card for shit that I'd already enjoyed on this planet, and half of it I couldn't remember.
Yeah. I think, from a financial point of view, that is probably it. It's don't spend money that you don't have, like credit cards and those types of things. Yes, they, serve a purpose, but, consumer debt is not good.
Yeah.
Business debt or property debt, yes, that's fine.
Even for me, mate, like I still have to practice this. So I've got some money invested off to the side, and term deposits say as well. Now, as the rate's gone up, the interest that comes in each month has become a bit more like, oh, this needs to go into the budget. It used to be a few drips and you'd sort of be like, well, it's not even going to get factored in. Now I'm like, oh, okay, that actually should be in there. And it's very tempting just to be like, cool, well, I'll just, the lifestyle can just change to that because it's coming out, it's not compounding. Yeah. So then what I've done is gone, right, let's increase my KiwiSaver contribution, some of the other investments that I'm making, and going, can I sustain this? Am I going to notice it? But we've all constantly been tempted by things that we could be consuming in the here and now, rather than playing the long game.
Playing the long game, and that's the key, and that's why old buff dog Warren, he's still playing the game at 93.
Yeah.
And that's why he's just so wealthy, man. Like,
don't interrupt compounding.
Yeah. And he just keeps doing it at 93. Like, he's still buying investments with 20, 30, 40-year investment timeframes, and he's 93, right? Obviously his shareholders' interests are in his head, but he's never not invested
Longer term.
longer term. He's always been doing it. And
I saw a quote, something like, he says, if you're not intending to hold a stock for at least 10 years, don't even think about holding it for 10 seconds.
100%.
Yeah.
100%.
I guess it's like, it seems like for people that don't have a lot of money and for younger people, it's easy for someone older to say because they've got all that hindsight, right? But like, it's literally the lesson. The lesson is there for you.
Well, you see it.
Yeah.
Like you see $10,000 invested in the NZX 50 back in 1970, what that would be worth today. I think it was like, it's done a 12.6% per annum compound over 53 years.
Yeah.
So it's like, and all you had to do is, and I think that's like 3-point-something million. So all you did was invest in, say, 10 grand back in 1970, which is quite a lot of money back then. But you held that investment for 53 years, you'd have a significant amount of money.
Yeah. Wow. And
you can't break the compound. You're going to have to go through the 87 87 share market crash,
Y2K,
dot-com bubble, global financial crisis. And if this is actually this is actually something that I thought about the other day. So if you look at back at the 1987 share market crash, it took nearly 10 years for the NZX 50 to recover, that one specific market. So is that something, that we could go through for the next 10 years? And that's, I guess, an important thing with KiwiSaver is you can actually have KiwiSaver strategies where all your investments are, say, in New Zealand assets or international equities or whatever. But it's quite important to actually have to have a geographical diversification. So some money in, say, the US, some money in Europe, some money in Australia, some money in New Zealand. So that if one specific economy struggles for 10 years, you've got that diversification that, other companies or other businesses all around the world are working for you. So that's why I prefer, say, a multi-sector KiwiSaver approach as to, say, investing all your KiwiSaver in, say, just one index.
And I think for Kiwis, like, if we haven't explored this space too much, you don't even really know that it exists. And an example for myself, I had a look at what the share price of Dior, who make luxury goods and stuff, and then Louis Vuitton, Moet, Hennessy, etc. And they're on a European market. And I'm like, wow, no wonder I've never seen them, because all of the platforms I use don't actually have access to those shares. And both of them are just up and to the right on a massive tear. And I thought, wow, imagine if you were dollar cost averaging into those, you'd be flying. But it's just a blind spot because I didn't even think about European markets.
Yep.
Yeah. So that's why it's important to think about diversification, but then also speak to people that know way more about this shit than yourself.
100%.
Okay. I know it's fashionable at the moment for people to be like, I want to be in the perfect KiwiSaver for me, and it's got to match my values and et cetera, et cetera. And I know that's why you put a lot of time into going through with clients your fact find. So Compound Wealth Fact Find. And that helps people figure out what the most appropriate KiwiSaver is for them. But what would you say around that space where people want to try and figure out what that could be?
Well, I think it's probably the biggest one is that I get asked is that ethical investment strategy overlay, and that's becoming more prominent. So, how's my manager actually investing, and what are they investing in? So, a lot of KiwiSaver providers now actually provide breakdowns of every single investment that you hold, while some, KiwiSaver providers, it's not very clear what they invest in. Well, it's not easy just to go to the website and click on a balance fund and go through and see the underlying holdings. So I think transparency in holdings is quite important, and then obviously having a lot of those, a lot of tools for, say, budgeting or forecasting what their potential retirement outcomes could look like. So more KiwiSaver providers are investing in those types of resources to just give the everyday KiwiSaver investor a more educated experience.
So there's more that you'll log in and you'll see what your projected balance is.
Yeah, well, and they've got like a like Booster, for example, is a KiwiSaver provider. They've got an app called My Budget Pal. So they can actually link all their bank accounts, link their credit cards, and it's effectively like a PocketSmith. You would have heard of budgeting at PocketSmith, but it's a free one that they give to members, so people can actually track their day-to-day expenses. And it provides, and they can actually put other investments in there like shares or property and what the valuations are, and it's quite a cool app. So there's different KiwiSaver providers are trying to add value, not just in the obviously just the pure investment returns point of view, but like obviously helping people get a better grip of maybe what they're spending. And
I actually thought an awesome KiwiSaver provider would be KiwiSaver, but at the same time financial education.
Correct.
And which it sounds like that's effectively the journey they're going on.
That's what a lot of them are doing. So it gets better every year, I think.
Yeah, it'll be very interesting as the money gets bigger. I wonder if KiwiSaver providers in some ways will become the trusted advisor for people, because they will potentially have the biggest amount of money sitting with that KiwiSaver. So the more that people trust those providers, they may step into different spaces and say, hey, we'll give you some advice over in this space as well.
Oh, 100%. And that's definitely common in the US with, groups like Vanguard, and they've got pretty much massive advisor channels that obviously just deal in those types of products. In Australia, when I was in Sydney a couple of months ago, it was amazing how many billboards and, just the level of kind of the visual level that all those KiwiSaver providers, not Australian super providers have over there. It's such a big industry that, a lot of them are doing, sponsoring different stadiums, and it's, compared to where we're at, but who knows, in 20 to 30 years it might be
completely different.
Could be, Mount Smart could be renamed to KiwiSaver Stadium.
Yeah. Wow. Saving the Kiwis. How good. And so I suppose as well, the main things like performance, people would have been big on, and fees and those types of things, and probably been able to see your balance when you log in. But so that's what you do. You're basically trying to pull out what people's preferences are and then match them with the right KiwiSaver fund that's going to keep them happy with most of those requirements.
So we look at fees, performance, organizational capability, so like who's actually running the business, how much staff turnover they have, because obviously people in there managing the money is obviously very important. So those are some of the things that we look at. Asset allocations probably one of the bigger ones as well, because a lot of the time, you look at, say, a growth fund or a balance fund, but it could be of more conservative nature once you look under the hood and go, well, actually this only has a 75% allocation to growth assets. Or so yes, sometimes it can be called a growth fund, but when you actually look under the hood, it could be like a conservative growth fund, if that kind of makes sense. So it's kind of just always looking at the product and the name, but then going and having a look where those investments are. Does their aggressive fund have a 98% exposure to equities, or is it only a 90% exposure to equities? So all those types of things you're looking at, because if I know a client has a 20, 30-year investment time frame and can stomach a lot of volatility, then I'm going to be recommending a 99% equity KiwiSaver portfolio. Because we know over the long term that's going to give the best potential for maximizing their returns. The trade-off is just they're going to have a high level of volatility compared to, say, a 90-10 or an 80-20 portfolio, which is roughly the rough allocation of a growth portfolio is 80-20.
So it sounds like the riskier portfolios usually end up with more exposure to businesses around the world. Yeah. So any thoughts then on KiwiSaver versus property versus business?
Great question. I think it's just one of those things, what your circle of competence is, right? At the end of the day, don't put all your money into KiwiSaver if you want a bit of flexibility. But if you're just happy working your job and, getting a house and paying down your mortgage, and then, KiwiSaver's your other investment, then great, because we know that it'll deliver a, pretty good return over the long time. over the long term, based on what type of fund you're in. But yeah, property is a great investment as well, and business is a great investment as well. It just comes down to what you're comfortable with.
Yeah.
For me personally, I love business. So, I invest a lot of money in my business and other businesses because that's what I enjoy. I'm not a big property person. I've done it in the past, but it doesn't get me fizzing. So I kind of want to do the business thing because it's what interests me.
Yeah.
So I think that's the asset class that I will follow. But I think there's pretty much two assets that you want to be in, and that's either property or shares. But we know that shares over the long term, do outperform property. But the leverage thing comes into play, right? So
yeah.
But I'm more of a business person, shares wise.
Interesting thing to note, because this is really important at the moment with more discussion around capital gains taxes and higher taxes, that often you'll see people who make money in business, like you said, that's their thing. That's what gets them fizzing. That's what they enjoy. And often they'll take their wins from business and they'll build their nest egg.
Yep.
And someone will knock on the door and go, hey, do you want to kick a little 20 in over here?
Yeah.
Got any resources you're keen to allocate to helping us get this business off the ground?
Yeah.
And business owners can't help themselves because that's what they love.
Yeah.
Now, when you tax more of that, then we squeeze the capital a little bit, because those people then may have to, especially if we have a wealth tax, for instance, may have to, go, well, I've got to pay this tax bill now. So they'll think about some of these investments differently. And I just think it's probably a little part of the conversation that often gets missed around increasing taxes and things like that, where people who may have taken a lot of risk to be able to create some of this wealth, they still want to, because that's in their DNA and that's what they do. And then a young fella like myself comes along or something and wants to have a crack at a business or whatnot, and people go, yeah, I'm keen to invest into this. So that's just going to be interesting to watch play out in this space as the whole tax conversation increases.
Yep.
Yeah. Okay, mate. So how much should we be contributing into KiwiSaver?
Oh,
it's a difficult one.
Well, look, obviously you should be in KiwiSaver, and the minimum you should be doing is 3%. Again, it comes down to, what you're comfortable with. If you think you've got the discipline to take a long-term approach, and let's say 10% of your money goes towards, say, your retirement savings, 3% of that's obviously going to be KiwiSaver. If you think you've got the discipline to invest 7% and achieve, say, a greater than an 8% level of return, then go for it.
Yeah.
But I think with KiwiSaver, it's one of those things where, if you did contribute 6%, you've still got 94% of your money to, invest elsewhere. And you're just kind of de-risking yourself as well. You're going, right, well, I've got a professional manager investing in a broad range of assets, everything from, shares and property. I just think it's a good thing to have, because you're diversifying. So minimum, you should be putting in 3. If you kind of don't want to do things outside of it and you're just happy to go and work and doing sport or whatever, then put more in your Kiwi. Yeah. But if you're a pretty savvy person and like taking risks and building businesses or building property portfolios, then go for it.
Yeah. Because I guess there's no financial incentive to put in anything more than 3% of your income, right? Yeah.
No.
However, if we look across the ditch, the minimum, I think, it's in the double digits.
I think it's gone up to 12%.
Yeah. So
huge.
Yeah. And I just think that's the lesson. Like, that was the smack in the face for me of, okay, it's 4 times what we put in here. And there's this compulsory, ours is voluntary.
Yeah.
Who do you think knows more about this stuff? Them or us?
The bloody Aussies, mate.
Yeah. Damn it. So we might have to just accept that, maybe because I think the risk for people is that they go, cool, I'm doing KiwiSaver, I'm sweet. And then you get down the track and then you run a calculation of what that's going to look like at 65 and you realize, Wow, that's not the figure that I thought it was going to be.
Yeah.
And it also, those calculators are based on your income staying the same the whole way through to that too.
Yeah.
When really we know, people may peak at an income level and then it may start to drop back off as you maybe get to the high of your career, and then you may maybe start to earn a little bit less as you get closer to 65.
Yep.
So I guess everybody's got to think about it individually, right?
100%.
Yeah.
There's no one size fits all, but we can look at, say, Australia, and we can look at, say, guidelines that say, 10% of your income, should be at least put towards your retirement. Which, I think 10% would depend. It comes down to that personal thing, depending on age and everything. But
who's got the best tools to be able to do some of those calculations? For instance, are there any that you sort of go to that people wouldn't know exist?
Well, sorta.co.nz, they've got some good tools there. But a lot of these calculators are online. They don't really, you've got to have set projection rates. So, a growth fund has to be 4.5% per annum. Yeah. I've actually got my own tools. So I'm actually looking at the moment creating a calculator. So that's going to be on my website. So check back in this space in maybe a month or 6 weeks, and hopefully I've got that calculator live. And that'll be not just an accumulation calculator, but it'll be a decumulator as well. So, if you get your KiwiSaver to age 70 and you want to draw down $1,000 a week, how long will that money last you in years?
Okay.
So, obviously, we talked about in that previous potty that accumulation is a primary goal for everyone, but decumulation is just as important. And, you want to be able to spend your money in retirement and actually not have to worry that, will I have enough? And that's what I do see a lot is, people coming to me, oh, well, I've got all this money in my KiwiSaver, but they don't want to spend it because they're scared that they're going to run out. Yeah. So they're literally just holding on to this money, right? Because, I don't want to touch it so if we have tools available for people that they could actually log in and all go online and put in, say, 200,000, 300,000, 400,000, whatever it is. Well, how long will this money last me based on, if I live to 90? And what's the best way to structure my portfolio? Should I have 30% in a growth portfolio, 40% in a balanced, 20% in conservative and 10% in cash?
Because that will change massively as you get older, right?
That'll change massively. Because the average, like a lot of people now, live to 85, 90, and that's going to only get older and older and older. So someone being 65, and if they're going to be using their KiwiSaver for another 20 or 30, 25 years, then they should probably have 30% of their portfolio maybe in a growth fund, because they're not going to be taking that growth portfolio, touching that for maybe 10 or 15 years. So what you're doing is you're having more of a bucket approach to your retirement savings. So that's another kind of KiwiSaver myth, that because you get to age 60, your KiwiSaver balance needs to be in conservative funds.
Straight into cash.
It's straight into cash, because it's like, well, what's your actual goal? Well, my goals, we're probably not going to touch it till I'm 70 or 75. Well, you could probably definitely be a bit more growth orientated, especially if you're going to be working, right?
Yeah.
Because your contributions, your dollar cost averaging. So I think that's definitely one thing that that's one thing that I've come across quite regularly, and I'm always educating people. Well, what's your goal? Are you going to keep KiwiSaver invested till 75, 80? Well, great. Let's have a portion in growth, a portion in balance, and we know that in the next 5 years you're probably going to take $100,000 out of it. So if you've got 400,000, we'll put 25% of it in a conservative fund, and we'll just have it there, or have it in a cash fund, and they just draw from that pot, while the other 75% is in a balanced or a growth portion, because they're not going to be touching that for another 5 or 10 years. So there's definitely that split fund approach that can help retirees.
All right, mate. Well, most people listening to this probably aren't retirees. So your clients, what are they putting in on average that you see? 3%?
I would say probably close to 6.
Really? Yeah.
Well, that's because I think, the people that actually seek kind of advice
They're not sleepwalking.
Well, the people that listen to this podcast, right, are obviously, they're trying to better themselves, and they're probably, they're doing great because they're here and they're listening and they're trying to learn. But there's obviously a lot of people that do bury their heads in the sand and go,
yeah,
what's KiwiSaver? The government's going to steal my money. So,
yeah,
you know what I mean? So I think the people that I've dealt with over the last, 6-7 years that I've been doing this is most of them would probably, average around that 5 to 6% mark.
Yeah.
Which is good.
Bloody oath. Okay, can you tell me about, you mentioned to me back in 1993,
Yep.
I was 5. There was a compulsory retirement scheme. I was just getting glasses and going to school to get bullied, but apparently a lot of Kiwis are about to do their ass and lose a lot of cash. What happened?
So 1993 with old Muldoon.
Yeah, well, there was a compulsory retirement scheme was abolished and members were given access to their savings.
Yeah. So the opportunity cost of that is just
huge. Yeah.
So that was a bit of a travesty.
So people built up these balances, but then they were given them and
boom.
Yeah.
All gone.
So here we are again.
And
16 years into KiwiSaver.
Yeah.
Yeah.
But it's I think if that happened to, say, a 30 or a 40 or a 50-year-old, yes, that money's going to go pretty quickly. But for, say, a 65-year-old, obviously you're at a mature age of life, right? And going to Vegas and going to, traveling the world or buying that new jet boat or whatever is, you've kind of been there and done that. So when you do kind of get that lump sum retirement money, you're not going to, frizzle it all away. So that's I think the biggest problem that we're going to have with KiwiSaver going forward is people are going to be too scared to spend their money.
Interesting.
I think that will be it, because I see it so often, like people in their 67, 68, they just don't want to spend it because they're scared that they're going to run out of money, so they keep it. But if they had some advice on, well, hey, this is actually how long it'll last you.
Tuck into it.
Yes, you can afford to spend $2,000 a month out of your KiwiSaver balance, because by the time you turn 88, it's all gone.
Yeah.
And then you've got your house that's worth, say, $1 million. Well, if by the time if you're still living at 88, you might move into something smaller, sell your $1 million property, and move into something smaller for, say, $600,000, and use that $400,000 to get you through the next decade. And if you're still living at 110, then good on you.
Yeah. Shit, we need to learn from you. Come on the pod. Final myth, mate. Kiwis are good savers. Yes or no?
No.
Yeah. Not ready for retirement.
No.
Yeah. Woefully unprepared, aren't we?
100%.
I think it's the elephant in the room as a nation we're not too keen to really address, because it always comes back to an argument about superannuation rates and ages and stuff like that, when really we should be, you said before, people won't put money into KiwiSaver because they're like, the government are going to steal my money. Well, they're already doing that. Like, they're increasing tax rates. They're not adjusting tax rates for inflation. They've increased the tax take massively over the last 5 years. Like, it's happening in front of you anyway, and people are like, nah, I'm not saving for my retirement. Like, seems.
Yeah. Well, it's just trying to live day to day, which I can understand.
And then they'll say, oh, same thing. They're gonna take my money. Well, they're borrowing as well. Who's going to repay that? You are. Like, so they're already doing it. So you've got to do things for yourself to ensure that you can have the things that you want, or that you can protect yourself, or you can give yourself options. And that's one of the reasons why I increased my contribution to KiwiSaver, so that in coming years, I've got options. Like, okay, now I can dial it back, or whatever I want to do. But also longer down the track, I know that the future version of me will thank myself, because
100%.
It'll be completely different if I didn't do it.
And I always come back to this, but what you're doing is you're effectively putting in place a life insurance policy. So, that extra 3% that you're putting into your KiwiSaver on top of 3%, that's, you can call that your, if Luke gets hit by a bus, fund. And that goes to your kids or whatever, instead of paying the $200-300 a month in insurance premiums. That is only increasing. I saw I think my personal insurance. I think I looked at one of the review document that I got the other day. It was up 18%.
Yeah.
I was like, what?
Yeah, I know. Mine's gone past 3 figures when it comes out of my bank account. And I'm like, it used to start with a 6.
Yeah.
Yeah.
Yeah. So it's like, well, if you start in your 20s, you put in that, that the 30s, you put in a little bit more into your KiwiSaver, at least you're going to get that money out at the back end.
Yeah.
And it's a form of life insurance, 100%.
Very wise, mate. Well, thank you for your time as always. We've covered a few myths and a few FAQs there. So thank you.
No, great to be on, mate. Always enjoy it. So,
and if people want to find out more about what you do and stay close to Compound Wealth, how can they do that?
You can go to our website, compoundwealth.co.nz. If you want to complete our KiwiSaver discovery quiz, go to compoundwealth.co.nz/KiwiSaver, complete our quiz, and then we'll get a personalized KiwiSaver report to you. Hopefully in the next 48 hours, depending how busy I'm going to be. But
or whether you're on pods.
Yeah. But yeah, look, and no questions are silly questions. So
good man.
We try and help as many people with KiwiSaver as possible.
Ladies and gentlemen, Adam Stewart, one of the good guys. Thanks as always, mate. We'll see you next time.
Thanks, mate.